Hello everyone, welcome back to my channel. So today it is Saturday, August the 22nd, and this week was once again a very good week for us, especially because it was not a good week for the overall economy and the markets as a whole. But given the fact that we were fully exposed to metals, we are in a position to capitalize from bad news on the economic front. And this week it was especially the case because um, somewhere in the middle of the week the U.S. government finally reached the threshold of the $40 trillion in debt, highlighting that it more than doubled over the course of a decade. And as you can see here, 10 years ago, the debt was at 19.4 trillion. And this period, 10 years ago, covers specifically the first Trump administration, the Biden administration, and the current administration of Donald Trump. Many things happened in between. Of course, there was a pandemic and all the programs, the spending programs that were associated to it. And now, currently, with this administration, the current conflict in the Middle East, and that has a very very particular role in what you see right here, that the Treasury reported already in July 432 billion dollar deficit, right? The highest monthly total since March 2021. And so this is, as you can imagine, a path towards a very, very dire situation for the United States. And as a result of this, the US Treasury yields, and looking here at the chart for just the week, here it reached a maximum level. This is the 10-year yield, by the way. They reached here, they surpassed the 4.74%, and here the 30-year bond yield also reached at a similar point in time this week. They tipped over the 5.32%. There was some relief afterwards, especially on the back of the announcement by the Secretary of Treasury, Mrs. Scott Bessent, that they would double the amount of debt buyback in an attempt to steady the bond market. So basically how this works is that because the government is currently running a budget deficit, they will have to issue short-term debt, and with these proceeds, they will use it to buy back long-term bonds. So they will essentially try to flatten the yield curve, because these long-term bonds are a benchmark for mortgages, and by doing so, they will try to cool down the bond market on the long end of the curve, of the yield curve, and by doing so, attempting to make mortgages a bit cheaper for house buyers, and also it will allow to alleviate a bit more these very high interest rates, or the high yields that are currently happening on the long end of the yield curve. But as you can imagine, because you are issuing short-term debt, which must be rolled over sooner, and because the interest rates continue to increase as a trend, when by the time this short-term debt needs to be rolled over, chances are it will continue to be rolled over at the ever higher interest rates, especially because inflation continues to be a threat. And by increasing by the bond market increasing the yields on the US Treasury, they are basically saying that, all right, we assume that inflation will be staying around for a longer period of time, and so we are trying to undercut any attempts by this administration to try to inflate the GDP, or to use high inflation as a way to lower their debt burden, and by doing so, devaluing the amount of debt that they have. And so this is something that provided, as you can see, some relief to the market in the aftermath of its announcement. But after a while, the market started to come back up, and the yields started to rise again, because this is only a band-aid. This is only a very, very short-term solution. The only solution which will be deemed effective to counteract this is simply to balance the budget. There is no other way. The United States will either have to cut spending or increase taxes, or a combination of both. And hopefully the Fed will also help in not increasing interest rates for too much more. But again, this is a situation which has only one effective long-term solution, which is balancing the budget. And on the back of this situation, the markets had the equity markets, along with the bond markets, did not have a positive week, but we had. And here, as you can see, we only have left SLV. We were called away in our holdings of the IAU, and so at the moment we are only bearing a loss, unrealized loss of a little bit over $31,000. So things keep improving in the right direction, but we are still not out of the woods yet. This one, the SLV, will be the most difficult one to get rid of. We are still a bit far away from the price at which we can try to dispose our shares, which is a $69 mark. As you can see here, the current cost basis is 68.56, and so we will need to get at least 69 to make sure we get out of the trade with a little bit a small capital gain, of course. Or we can try to sell at 74 to try to correct our performance chart by having a capital gain, but still it's not going to be very effective, because the gain that we would have in that situation will simply correct for the loss, but would not reflect the gain. And so yeah, that's a no-win situation for us. But again, moving on, I filtered here our scoreboard for the IAU shares. As you can see, we bought 400 shares at 86.5 and another 400 shares at $82 each. And now we managed to sell those at 85, and our cost basis was 84.25. So we managed to get a $600 capital gain. As you can see here, we had on these first 400 shares, we had a loss of $600, but on this one we had a gain of $1,200, and overall we got that $600 capital gain. And with all the premiums that we collected, which were 993,000.05 cents, which in conjunction with the capital gain, it gives us an overall gain of $1,593.05, which is exactly the calculation here that we get by summing the gains that we had, premiums and capital from both the shares. The premiums on these on the calls of these 400 shares were still enough to offset the capital loss in these shares, and then with this one we basically went definitely in the green. And now going back to here, as you can see, we managed to sell them here. These are the 400 shares sold. We sold them at 85. We received $60,000 of proceeds, and all the other puts that we had on IAU expired worthless, of course, because the call was assigned, and these 54 calls on the SLV, obviously at 69 strike price, did also expire worthless. And it was quite surprising on the negative side that I was forced to let these puts expire simply because I could not buy them back at any point during the week. I tried to buy them, of course, buy them back at competitive prices, like 1 cent or 2 cents, because as the price inched up and up as the week went by, these puts, if this was any other ETF, these puts would be easily bought back at 1 cent or even at 2 cents. But I tried both prices. I was never able to buy these back. There was simply not enough liquidity in this. There is simply not enough liquidity in this ETF to buy the puts back. And so because of that, I simply had to let them expire. And the same thing happened in our Emirati account. So this is really not a good, not an optimal ETF to invest. And as part of my plan moving forward, but I will get to there at some other video. Any further exposure in gold that we may have, of course, we're going to have to put up more money in collateral, but this one will be much better. And because this is an extremely liquid ETF, this is basically the equivalent of our SLV almost. And because we have stock options expiring every single day, and it is an extremely deep ETF. So next time I will try to get some exposure to gold. This will be the go-to ETF. In the meantime, with the increase in price that we had on the SLV, we continued to roll up our puts on the SLV. As you can see here, we started with puts at around the 56, and these 54 and 55 that came from last week were still there, but as you can see here, we had to roll up our positions consecutively from 54 and 55 to 56, 57, and then 58, 59, because the price simply continued to go up and up and up. And now at this point, these puts, when we sold them, they were only around 10 delta puts, so they had a 90% probability of expiring worthless. But still, it will allow us to bring our cost basis down somewhat, not as much as I would want. But if these puts are assigned, these 58 puts are assigned, and we have 14 of them, not 11, because we have 3 other puts sold in our Emirati account. If these are assigned, we'll bring our cost basis down by more than $2, down to 66.38. And if these 12 puts are assigned as well, the cost base will come down to 65.05. So as you can see, this is not much of a progress. Even by selling 12 additional more puts, the price only comes down by a little bit more than $1.30. So this is a very little progress for the amount of money that it's being committed in these puts. And so we are reaching a situation in which adding more puts will not make a difference to the cost basis. So I'm considering that with these $100,000 that we have from the puts of the IAU, the money that was released, and the proceeds of the shares, we can double down on these. But if the price remains this way or goes into the 63, 64s, we might as well do something else with this money and wait. If there is a pullback, to deploy this money again in more SLV puts, or simply wait that the stock will not remain around the 63, 64 level and will simply continue to go up all the way to where we want, which is around the 69 level. However, for next week, we have 54 calls to sell. Probably, if I could sell again at 69, there's a chance that we may get some good premium out of it. If we sell again a 60 calls expiring on Friday, next Friday. As you can see, these are prices for Friday, so they will the cost or the premium will be less, but still there is a possibility that I may end up jeopardizing the premium and going for the 74 strike price, to keep the possibility open of getting that capital gain that I would like to get. And if I see that the price of the SLV does not go up, we simply roll down all the way back to the 69 price to get some additional premium. But this is something that I will have to consider when the market opens, because it's really very, very undefined at this point, and we have to see what the market will do on Monday. But yeah, we got already rid of most of our holdings, which were what we wanted, and we are much closer to the end of this challenge. So yeah, we'll see what's going to happen. And so let's move on to our Emirati account to see what is going on over there. And here we are in our Emirati account, and here, as you can see, the same thing happened here, in the sense of we could not buy back our puts on IAU, so we had to let them simply expire. And we already, as I mentioned, the 3 remaining puts on SLV with the 58 strike price are right here, and we just now have to wait and see whether we will roll those up or we'll simply let them expire. It will all comes down on whether the price of the SLV will continue to go up or we'll have a pullback. Hopefully this will end up soon, but we'll see. For the time being, this is all. Feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And we'll reconvene next Monday to see what trades did I do so that we carry on towards the end of this challenge. And I'll see you there.